Hello and welcome to the latest episode of Damien's Midweek Markets, which is the show where I talk about what's been happening in investment markets and what to look out for in the days ahead. Now, it's all about the G20 because over the weekend, the G20 summit happened, but more importantly is what went on in the sideshow with Donald Trump and President Xi of China, which is what everybody was focusing on, the potential for a trade war truce. Now, last week I talked about the possible outcomes, and one of the outcomes would be a total trade truce, another one would be an escalation in the trade war itself, but there was always that middle ground. What we had back in December, in fact, when we had similar meetings and we had a temporary truce. So basically, Donald Trump agreed not to raise any more tariffs for now. He's done that before and then raised them, so be aware of that. He said he wouldn't raise tariffs again for now, but both sides agreed to go back to the table and try and form a long-lasting truce. Now, the market obviously liked this because it'd been waiting for some kind of positive news around the trade war, because if you remember back at the beginning of May when Donald Trump threw his trade wobbler, then the markets all went a bit wonky and they sold off and equities fell and we had bonds do particularly well and treasuries. Now, with the positive news, the S&P 500, the US stock market, spiked higher and it leapt initially by over 1.5%. But what was interesting on Monday, as the day continued, there was almost a continuous decline in that leap, that gap higher. They call it a gap higher because from where the market closed on the Friday to where it opened was, if you look at a chart, a nice gap. Now that gap higher started to be filled back in. That suggested that the level of buying wasn't quite as strong as people initially thought it would be. So there was talk of maybe it was some of the short selling covering. People who'd gone into the weekend selling the market, betting that something would go wrong, that the trade war would escalate. And therefore Monday, where there was some positive news, they were having to unwind those bets. And if you want to unwind a short, you have to buy the market. So it pushed things higher. So by the end of the day, we still clung on to new all-time highs in the US equity market, which is an important point. So we've had new highs higher than the ones we had in April and higher than the ones in September. And if you look at a chart, you can see that those highs are coming at a quicker rate of knots. So if you look at that space between September to April and then the retests all the way along, they begin closer and closer and closer before they've pulled back. Now at the moment as I make this video, which is on a Tuesday, the equity markets in America have been fairly flat. So after yesterday's euphoria, they now are pausing, but they've not yet unwound or collapsed. So they're sitting on that all-time high as a level of support now. Markets are now looking at 3,000. That is the big target. It's a round number. Traders love round numbers. Investors love round numbers. So psychologically, the odds are increasing that we might start to head towards that. Now, when we get to 3,000, who knows what will happen. If you're looking down below, then you've got to look at 2,900 for support and down to 2,880. Now, there's going to be a lot of support on the way down there, but if the market suddenly broke lower, below those levels, then you might start to be concerned and we might end up breaking much, much lower. But for now, the market is happy that the trade war seems to be some positive news. And also don't forget that the Federal Reserve and other central banks have been making very positive noises about supporting various economies around the world and therefore, by default, the stock market. But while the fear left the market, so we saw the VIX fall back down way below 15 and got down to that 13 to 14 level. So that suggested that the fear had gone out of the market. But if you looked elsewhere, if you looked in the bond market, they barely twitched really based upon the trade war positive news from that G20 meeting. There wasn't the strong reaction you saw in equity markets. In fact, while yields did pick up, they then started to head back down towards a 2% level. And I'm talking about the 10-year US Treasury yield. But that pattern was repeated worldwide. We're still now seeing all-time lows on government bonds from Germany and other European countries. So there's still a sign of nervousness in the bond market and a general disbelief. They're not really buying what is going on out there in terms of the trade war, because we have been here before. And Donald Trump was already starting, he didn't backtrack, but he was starting to antagonize slightly on the Monday, trying to slightly antagonize China once more. So we've got to be careful of that because, like I said, we were here in December, then within weeks, the market completely collapsed, then hit its low on the 24th of December. So why doesn't the bond market quite buy into all the hype and sell off as you'd expect it possibly to do? So the yields get higher, which would mean that the capital value of the bonds themselves fall. So why isn't the bond market convinced? Now, one of the reasons is because they look at more at the fundamentals. So while there's been positive news about the trade war, it's very much headline based and there's no sort of real action being taken just yet, just all sound bites. Now, the fundamentals of the economies globally are still starting to slide. We're still seeing poor economic news out there. So the market, the bond market, is still pricing in the odds of a recession at some point in the next 12 to 18 months. So it hasn't changed anything from the bond trader's perspective. And why wasn't the equity rally much stronger? And why did it start to tail off again? There might be some skepticism around whether the trade war truce will last. Again, maybe some skepticism about whether the trade war truce will last. But the other reason is that the earnings season is coming and there's a lot of companies starting to make noises about having a particularly poor earnings season. So their projected earnings are actually being downgraded. Now, of course, if earnings are downgraded, then that means that the share price is likely to fall. So although we've had some positives from the Federal Reserve and we've had positives from the trade war, some good news in that front, we still feel like we're very much where we were a couple of weeks ago. And can the Federal Reserve really prop up the market? So it's going to be interesting what's going to happen in the days and weeks ahead. Going forward, look at the 3,000 level on the S&P 500. The FTSE 100 is back above 7,500. So it'll be interesting to see if that holds. But what we want to see is a bit of breadth in the market. So we want to see other sectors, the cyclicals, all starting to join in the rally. So we need to have a look at that. So that is it for this week. As usual, if you want to get in touch, then email me, damien@moneytothemasses.com. You can catch me on Twitter at moneytothemasses with the number 2, and of course on Instagram. So until next week.